March 2020, the market crashed faster than almost anyone had imagined. In just a few weeks, Nifty lost more than a third of its value. Investors were selling in panic, and news channels predicted even worse was coming. But here's the question that fascinated me. What would a simple momentum strategy have done during one of the biggest crashes in recent history? Would it have stayed invested or completely avoided the crash? I ran a 10-year backtest on the Nifty LargeMidcap 250 universe, and one particular result genuinely surprised me. Here's the strategy we'll test. Our universe consists of the Nifty LargeMidcap 250 stocks. Every month, we rank eligible stocks based on relative momentum. In simple terms, the strongest performing stocks move to the top of the list, but before a stock can even qualify, it must pass two filters. First, its price should be within 90% of its 52-week high. This keeps us focused on stocks already showing strength. Second, the Nifty itself must remain above its 100-day exponential moving average. Think of this as a weather forecast. If the overall market trend turns negative, the strategy simply avoids taking new positions. Every month, the portfolio is rebalanced into the highest rank qualifying stocks. No predictions, no opinions, just predefined rules. And today, we'll see exactly how those rules behaved during the COVID crash. Let's keep everything transparent. Here's the complete setup. Universe Nifty Large Midcap 250, portfolio size 10 stocks. Initial investment 5 lakh. No additional contributions, monthly rebalancing, relative momentum ranking, and the key market filter, Nifty must remain above its 100-day EMA. Now here's where things get interesting. Most people think momentum investors simply ride the market down. Let's see what actually happened in 2020. As we entered 2020, the strategy was fully invested, momentum was strong, the trend remained positive, everything looked normal, but then the market started changing rapidly. This is the moment everything changed. At the beginning of February 2020, the Nifty opened below its 100-day EMA. That single signal changed everything because according to our rules, the strategy stopped taking fresh entries. No prediction, no human intervention, just a rule. Here's the shocking part. From February all the way until June 2020, the strategy generated no new entry signals. It simply stayed out. While markets collapsed, while headlines became more frightening every day, the strategy did absolutely nothing, and sometimes doing nothing is the smartest decision. Instead of trying to predict where the bottom would be, the system simply waited patiently until conditions improved. Eventually, the market recovered. Nifty crossed back above its 100-day EMA. The strategy started buying again, not at the exact bottom, but after the trend had clearly improved. This is where many investors criticize trend following strategies. They don't buy bottoms, and that's true. Instead, they try to capture the middle, which is often the largest part of the move. Over the full 10-year period, 5 lakh became 72.62 lakh, excluding the brokerage. That's a total gain of over 67 lakh. The strategy delivered a CAGR of 30.68%, and maximum drawdown is just 12.91%. On contrary, Nifty crashed more than 37% during this COVID crash. But our strategy only experienced the drawdown of 12.91%, which is an impressive outcome. But here's the part I found most interesting. The COVID crash wasn't avoided because the strategy predicted it. It wasn't avoided because someone read economic news. But it happened because a simple market trend filter which told the strategy that the conditions are no longer favorable. So it didn't create any new positions. So why did this approach perform so well? Three reasons. First, the trend filter. Instead of fighting the market, the strategy respected it. Second, relative momentum. When the market recovered, capital naturally moved toward the strongest stocks, not yesterday's winners, today's leaders. And third, discipline. No panic selling, no emotional buying, no guessing, just following the rules month after month. This doesn't mean momentum investing avoids every loss. It doesn't, but it can help avoid staying invested during prolonged market weakness, and over time, that difference compounds. If you'd like to explore how different momentum strategies behaved during events like the COVID crash or 2008 financial crisis, you can run your own backtests on Continuous platform. Link is in the description below. We also publish weekly momentum investing research, step-by-step backtests, and evidence-based strategy breakdowns through our Substack newsletter. Also, we will publish the full backtest result of this strategy with stock-wise entry and exit in the current week newsletter. If you are serious about quantitative investing and wealth creation, consider subscribing. Thanks for watching. I'll see you in the next video.